Welcome back. In this video, I want to talk a little bit more about how we actually record transactions in an accounting system. I want to begin this discussion by talking about something called the cash basis. If we were to use a cash basis form of accounting, the cash basis system would recognize revenue when it's received and expenses when it's paid. When we say recognize revenue or recognize expenses, we're talking about when these items are recorded in your accounting system. Cash basis is very simple. It records revenue only when you receive cash, and it records expenses only when you pay cash. The cash basis is not actually in accordance with GAAP, generally accepted accounting principles, but some really small businesses might use the cash basis because it's very simple. However, the cash basis has some inherent weaknesses. For instance, the costs incurred to generate revenues are not matched with those revenues. Cash is not always received when the revenue is earned. We know this is true because sometimes our company might go out, perform services, and then bill the customer on account. So the service might be performed today, but the payment might not be received for another month, or maybe even 2 months. Cash is not always paid when the expense is incurred. This is also true, as sometimes we'll incur an expense, such as utilities, but not pay for those utilities until a much later time. So to overcome some of these weaknesses in the cash basis, GAAP requires that we use an accrual basis form of accounting. Under the accrual basis, the recording of revenue and expenses does not depend on when cash is actually received or paid. It's not that we ignore cash entirely, we just ignore the timing of cash. So instead, the accrual basis attempts to match expenses with the revenues that they earn. There are two major accounting principles underlying the accrual basis. The first one is what we call the revenue principle, or sometimes referred to as the revenue recognition principle. And the second one is the matching principle, which we've already discussed. Let's talk a little bit about the revenue recognition principle. This principle requires that you record revenue under accrual basis form of accounting when it's earned, regardless of when cash is received. So this principle often raises the question of when revenue is actually earned. If you're performing a service, it's typically when the service is performed. So for instance, let's say you own a company that does landscaping, and one of your customers calls you and says he's going out of town next week, but he wants you to still come out next week and mow his lawn and trim his hedges. So he stops by the office today and he drops off a check for $100 to you in anticipation of you coming out next week to perform the services. So even though you have the $100 in hand, can you record the revenue in your accounting system under the revenue recognition principle? The answer is no. And the reason is because you don't have what's called a completed earnings process. You need to actually go out, mow the lawn, trim the hedges, and complete the earnings process in order to record that $100 of revenue. So we'll discuss how to actually handle those types of situations coming up here soon. If you're selling a product, this concept also applies. Typically, you can only record revenue on a product sale when you actually deliver the product. So the matching principle we've already discussed attempts to match expenses and revenues in the same accounting period. It's not perfect by any means, but we try our best to show the expenses that we incur in one period with the related revenues that they generate. Let's take a look at an example of this to get a better idea, and also contrast the cash and accrual basis. Let's say you own a flower shop, and right before Valentine's Day, your delivery van breaks down, which is definitely not a good time. So you go out and you rent a van for the whole month while the van's being repaired. Let's say that your flower shop pays the company, the rental company, up front on February 1st for a whole month's rental on the van, say $1,400. Then the shop goes out, uses the rented van, and delivers flowers. And you earn a total of $2,000 in revenues. Now those revenues are split. $800 of that $2,000 is paid in cash. In other words, you immediately went out, delivered the flowers, and the cash was paid on the spot. The other $1,200 was revenue that we earned on account, meaning we performed the services, we delivered the flowers, but the $1,200 hasn't been paid yet. It'll most likely get paid in March or April. So let's contrast these two methodologies and see how they would work. Under the cash basis, let's take a look at the first transaction, which is the $1,400 rent that you paid for the van on February 1st. Under the cash basis, would you record this rent? Well, the answer would be yes, because if you remember, the cash basis only requires that either a receipt of cash or payment of cash occur. So in this case, we had a payment of cash of $1,400, and using our form that hopefully you're familiar with now, your transaction would look something like this: a decrease to cash, an increase to expenses. When expenses goes up, net income goes down, and that net income going down as it gets transferred via the closing process also reduces retained earnings. As you can see, if you focus on the left side of this chart here, because assets went down and stockholders' equity went down, our basic accounting equation is still in balance. So yes, we would record this under the cash basis. How about the $800 you collected in cash from the customers? Well, did you get the cash? The answer is yes. So under the cash basis, you would record that as well. This entry would be an increase to cash, an increase to revenues, and therefore an increase to net income. And via the closing process, that increase in net income would also increase retained earnings, keeping your accounting equation in balance. Let's take a look at the transaction for the $1,200, the amount that you actually billed your customers for. Under the cash basis, you wouldn't be able to record this transaction. And the reason is because you haven't received the cash yet in February. It's not going to happen until March or April, most likely. So you wouldn't be able to record this transaction whatsoever. So under the cash basis, what would your calculation of net income or loss be? Well, in this case, we would show revenues of $800 and expenses of $1,400 for a net income or loss of $600. Now the question is this truly what happened in February? Is this a good reflection of what actually happened in your operations for the month of February? Well, let's take a look at the accrual basis. Let's walk through the same entries. Under the accrual basis, which requires that revenues be recorded when earned and expenses when incurred, would you record the $1,400 rent paid on February 1st? The answer is yes, because you incurred and paid those expenses right in the month of February. So your entry would be the same as the cash basis there. What about the $800 you collected in cash from your customers? The answer once again would be yes. And the reason being here is you would record an increased revenue just like you did in the cash basis, not because you collected the cash, but because you actually performed the services, and under the revenue recognition principle, you'd be allowed to record that revenue. The third transaction, the $1,200 that you billed your customers on account, under the accrual basis, would you be able to record this revenue? The answer once again is yes. Whereas in the cash basis, we weren't allowed to record this because we hadn't received the cash. In the accrual basis, we can, because the decision rule is, did we perform the service? Yes, we delivered the flowers, so we performed the service, earned the revenue. The only difference is we wouldn't have an impact to cash. We'd have an increase to an account called accounts receivable, which is an amount due from our customers. Revenue goes up, net income goes up, and retained earnings also goes up. So what is the net income or loss you'd record under the accrual basis? Well, under the accrual basis, you'd record a total of $2,000 of revenues against $1,400 of expenses, and you'd actually have a net income of $600. As you can see, a very different picture from the cash basis. Now, it doesn't always work out in your favor this way, but the question, or the true question, is what's a better reflection of what actually occurred in February? Well, an argument, a very strong argument, could be made that the $2,000 of revenues are the revenues we actually earned against the expenses we actually incurred of $1,400. So the $600 net income is a truer reflection of what really occurred in February versus the cash basis.